2025 still the title higher for longer. I didn't change it because I'm strongly believing that I continue to believe that we will have higher for longer, not only on the FMC, but some other central banks as well. Okay, but first, is USA inflation cooling down or just pullback? Because we had the release yesterday from USA inflation, and we had the latest PPI data as well. But we saw that the core measure and the nominal CPI is in somewhat red territory. So basically going lower than what it was before. So is this really true? Are we actually cooling down, or we continue to have inflationary aspects? Okay, so this is the first topic we want to be discussing. Second thing is the fiscal policies and political dynamics on France. Some of may know, some of may not know, but we've had the France revised GDP deficit target and some political maneuvers, as well as the UK inflation trends and the Bank of England potential rate cut. So, it was a big of a miss on UK inflation. The pound has weakened on that moment. So we're going to have a look on this. And third, but not last, and not least, is the Bank of Japan potential policy shift. I've talked about this yesterday, but very briefly. And I want to talk about this today as well, because I'm believing that we will have some sort of strong moves on USD JPY in the coming days. Okay, so we will talk about that in a second, but I believe that yes, a 25 basis points hike from the Bank of Japan is possible. Okay, it's possible, and we will understand why. I want to get in a little bit more depth, because we know that a lot of people may don't understand why it's so important for the Japan and historical context. We're going to give a little bit of historical context as well, and global market implications and etc. So but before we go any further, guys, here's the risk disclaimer. Please go through it. I'm going to give a minute, as always I do, and then we're going to start for sure. Okay, hopefully everyone had a time to read it. Let me just take this off now and put it through here in my other screen, so I know what I'm going to talk about. And let's open FinLogix. Okay, so we're going to start talking about the USA inflation. Let's open FinLogix. I'm going to send the link into the chat. There we go. And let's come to tools and then economic calendar as usual. It's one of the best economic calendars there is out there in the market. It's such a clean one that you can't even get lost in it. And then I prefer, most likely you will have all selected. I prefer to click on select all and then only on USA, and then come to recent and next, and you will be able to see the PPI and as well as the CPI. Okay, so you can take off the low ones, right? If you have low, you can just take the low impact off. That is better. So okay, the inflation came in somewhat of a different than what was expected. So the core inflation rate year over year came in to be 3.2% from the consensus of 3.3%. You know, so basically no one was expecting a change. So the previous was 3.3%, and the forecast was 3.3% as well, but it came in to be 0.1% less than what was expected. Then we have the inflation rate as normal, coming at 0.4% from the forecast 0.3%. Now, the biggest part that we have to understand is where did this inflation faded off and where this inflation is growing. To do that, what do we know? How we do it is we type CPI BLS, or you can just click on the link I'm gonna send you on the chat. So let me US CPI. Done. Sent it. So as soon as you you can just US CPI BLS. It comes to this page, and then you can click on here CPI home, and then you will come to this page. So from here, this is the official Bureau of Labor Statistics website. This is who makes the release of the inflation and all the data points. Okay, so how do you actually get access to it? Is you come to HTML right on the side here, news releases. CPI for all items rises 0.4% in December. So you click on it, and then it will open another page, or sometimes open on this page. Yeah. So here you have all the items for the CPI. Okay, so you have June, July, August, September, October, November, and December. Remember, guys, the release from yesterday is not for the month of February, it's for the month of December, okay? Because we didn't yet finish the month of December. Didn't finish at the month of November. January. We finished the month of December. So basically, if you look at here, there's always like a month, December. This is the representative of when the data, when this is the data, okay? So you have here the food item decrease by 0.1%, so that's pretty good. In general, okay, the whole food have decreased 0.1% from the November to December. Food at home decreased 0.2%, so that's really good. Food away from home, like fast food, etc., that no changes. Then we have energy sector. Energy sector rose quite a bit, substantially. Okay, November was 0.2%, and it came to be 2.6% now. And it tends to be because of the rise on gas prices as well as oil prices. It tends to be for this reason. Okay, this is why the core CPI is more accurate and is what the central bank takes a look at, because they can't control the price of oil, they can't control the price of energy, but they can control the price of, let's say, food, and they can control medical care services, etc., etc. So the core CPI basically excludes the energy and food prices. Energy and food prices. Yes, correct. So here you have 2.6%, so that was pretty high. Gasoline, all types, 4.4%, huge. Oil, 4.4% as well. Energy services came in to be higher than before. Before was negative 0.1% in November, and it came in to be 0.8%, totaling an average of adjusted 12 months on to 3.3%. Electricity, 0.3%, higher, as well as utility, piped, higher as well. All items less food and energy. So there we go. This is the core CPI. And we can see that the numbers are much more contained than what it was before here. Okay, we can see some big jumps from this area, but we don't see any huge jumps from this area, from the core CPI. So the central bank takes more count into the core than actually the nominal CPI. Okay, now I think the biggest moves was the energy prices, as well as gasoline, energy services. They had the biggest ones, because even shelter didn't had much of a change at 0.3% and then 0.3% as well. Transport, somewhat 0.5, but usually if we do some sort of median average term, 0.5 is at an average. Medical care services continue to be jumping lower from 0.7, 0.4, and now 0.2. And as I say, the most big would be the energy sector. Okay. So do you think that the inflation is actually coming down or pulling, or it's just a pullback? In my opinion, it's just a pullback. All right. The central bank knows that, FMC knows that, and I've talked about this yesterday with everyone, and it makes much more sense for them just to hold it for longer than continue cuts every meeting. Okay. If we have a look at the CME Fed Watch tool, I'm going to send the link to everyone. Just a second. Takes a while to load. Okay, let me grab the link and send it here. CME. Okay. Cool. All right, perfect. So the CME is 97.3% expecting no changes. All right. So basically the overnight swap rates from the servers of the CME is expecting no changes. All right. Now there's only 2.7% expecting some changes, but that's not going to happen. That's for the next meeting, the 29th of January. On the 19th of March, we still have 72%, so majority expecting no changes on the rate. So basically the first quarter, January, February, March, we won't have a cut. All right. If we look to the second quarter, we can feel it on May and June, no changes at all, and then maybe a 25 base points cut. All right. So pretty much in 2 quarters, we're expecting one cut. All right. We still have another 2 quarters. So no changes, no changes, no changes, and no changes. So basically the market is specifying one cut. And this cut is to basically happen on June. Okay, 18th of June. Will it happen? We don't know. Okay, because inflation next releases and NFP, the labor market seems very, very tight. Okay, labor market continues to be very strong, putting in some big numbers as we saw, 100,000 above what it was expected. So we will probably continue to see this rhetoric of higher for longer, more into the aspects of the news and etc. All right. My expectations is inflation will continue to grow. It will be a sticky inflation, not grow above 4 or 5% again, but it will be very sticky. Okay. So what can we do with the US dollar? Well, if the US dollar continues, if the USA continues to have such a big inflation, a very sticky inflation, and the Fed continues to be neutral to hawkish, saying that they will be data dependent, as well as we will maintain the rates higher for longer, we have time to assess. We don't want to take, controversial steps and, have to redo everything again for later. They will sound hawkish and the market will believe this, and the market will continue to buy US dollars. So most likely we will continue to see a stronger US dollar. This, winds up the opportunity for us to short euro dollar, for instance. And then we go for the second topic, the fiscal policies and the political dynamics on France. So in Europe, the fiscal and political landscape are pretty much undergoing a very significant adjustment, and with countries, you know, in this era of the world, they're grappling pretty much to balance the economic stability and try to be very disciplined on the fiscal side. France has been one of the, you know, center stages of the developments, and the Prime Minister François Bayrou unveiled a revised GDP deficit target for 2025. And initially he set at 5%, the target, and now he adjusted at 5.4%. To the reason why he did that, the reason why he say he did that was to address the political gridlocks and appears investors concerns. Okay, so basically this shift reflects a very strategic and trying to balancing the economy, and basically what he wants to do is maintain a fiscal credibility while navigating domestic challenges. Okay, so this is the two things he wants to do. He also announced a plan to reopen negotiations on pension reform, and a continuous issue that has previously sparked with on France. Sorry, someone sent a question. Who are the participants who make the 90%? So you mean into the CME tool, like here? Like, who are those 97.3% of people? How many people are they? Yes, okay. So basically, you can create your account here on CME, okay? Like my one, and you can vote, all right? You can pretty much try to predict what's going to happen. So it's a day-to-day people, as well as hedge fund managers, pension fund managers, everyone else, as plus the FMC maybe members, that they sort of put it, where do they think it will happen? Okay, and you still have the chart of the dot plot as well. That is pretty cool. I like to always show that. But most is like normal hedge fund managers, pension funds, etc. So it's just normal. It's nothing like out of the word. No, it's just like a survey. Yeah. Yeah. Okay. All right. So continue about the fiscal policies and the political dynamics on France. Not a problem, Bojo. On the UK, you know, as I say, we had a softer than expected inflation data, and the services CPI fell to 4.4%. And this is the lowest level since March 2022. Both market expectations were projecting to be higher, you know, and it was much lower. So there was a big miss. The easing on the inflationary pressures basically boosts the probability of a next month rate cut, in my opinion, for the Bank of England. Okay, it's now priced in at 85%, and the pound, you know, which would typically weaken in response to rate cuts, we can probably look at a strength instead, right? And the reason is because easing inflation alleviates the concerns over the potential gilt market crisis, and most likely restoring some investors' confidence for the next quarter, right? The Chancellor Revis has further reinforced that his positive sentiment by committing to fiscal discipline through spending cuts designed to meet self-imposed fiscal rules. Despite those measures, most likely that the UK long-term economic prospects remain very uncertain, and you know, have a lot of challenges of balancing growth and fiscal responsibility will continue to persist. If we look in a general of like on a very, very overview across Europe, the fiscal as well as the monetary adjustments basically illustrate that the diverse approaches taken by countries trying to get out of the economic uncertainty is not working. You know, as we have France has adopted a more proactive stance. UK has focused on leveraging inflationary reprieve for fiscal stability. So it's sort of everyone is trying to do one thing that when they could be working together. The broader sort of the Eurozone remains very sort of relatively stable, I would say, okay? But there remains a lot of concern in terms of growth, inflation, as well as monetary policy. Those types of developments pretty much shows to us that the fiscal and the monetary policy is shaping the market dynamics at the moment, and it will continue to be in 2025. Central banks, governments, all of those big institutions on Europe, they are trying to stabilize the economies, but it's generating something called as the ripple effect. And you know, they're felt more most of the ripple effects are felt more into the Forex market, as we can see the euro weakening, as we can see the pound weakening, as we can see all the currencies weakening as well. The euro, you know, as we had some short-term fluctuations, it's most likely to not see any significant moves unless more aggressive measures are introduced from ECB or anyone from inside the ECB. However, you know, there are some contrarian approaches within the region of Eurozone that are underscoring some challenges of maintaining cohesion in an economically diverse bloc. So Europe's definitely I would say a hard one, but I think there is an opportunity to be shorting Europe at the moment. Okay, that's where I'm coming from into my portfolio. How do you trade the mixed CPI data that was released yesterday? And Aditya asked me to NZD Outlook. And Jonas, thank you. Not a problem, Jonas. Always here to help you. Now, first things first. So, how do I trade the mixed CPI data? So as we see, all right. So basically, let's just have a look on let's say euro dollar. Everyone's trades it. Okay. If you take for consideration euro dollar yesterday and put this on the 5-minute chart, we had a huge gap as soon as the inflation came out. I was watching the market at that time, and it was somewhat interesting. Okay, somewhat interesting because we saw this big move up. Sorry, the wrong one. We saw this big move up, and then we saw the big move down. And now we're trading sideways. Most likely we will continue to head down towards the levels of here. Okay. Today or next week, I'm not too sure. But looks like that's where we're going into euro dollar. Now, same goes for NZD, okay? Most likely we will continue to see, let me take this off. Same thing will most likely happen to NZD USD. We don't have such a big opportunity here, but there is, come back to 50 minutes. Okay. They will probably come back to this area, okay? So maybe a pullback and then a push down. So I still very bullish on US dollar. Okay, very bullish on US dollar. It's very hard to be bearish at this moment, to be honest. Not against the USD JPY, okay, but definitely against like Euro, NZD, AUD is a big one as well. AUD is a good short that we could have as well, potentially have. But things like other ones here are definitely out of the outlook for longing it at the moment. Okay. So my opinion is if the CPI comes in like mixed, most likely when we see such a big up move, I just try to trade at the downside. So if it happens to the downside, I try to catch it to the upside. Okay. Especially when they have these huge gaps. Market gaps are always fill it up. Okay. The market can't have gaps. So what it will do is it will find a way. So it will find a way to close it. Even if it's like here and then pull back again, but we'll close it. So I try to find points of interference where I can enter and then to close this gap with the market. And then later I see what I do. Okay. So that's pretty much what I try to do. Did you make it sense, Sweets? That in terms of a technical perspective, now in terms of a more fundamental approach, I tend to come and then see what is actually going on. At the moment, we saw that the inflation is actually going down for all items less energy. Majority of them, 0, 0, 5, 0, 3, 0, 3, negative to 0, negative 0, 2, 0, 1, 2 to 1.2, 0, 6 to 0 0.5, 0, 3.0.2. So, you know, out of 2, 3, 4, 6, 7, 8, 9, 10 items, majority of them are coming 1, 2, 4. Yeah, so 50% of them are coming lower. So in terms of fundamental approach, what I would like to do is I would like to follow all items, okay, and see when will those food at home, food away from home, majority of the ones energy, in terms of energy commodities, gasoline, fuel oil, energy services, electricity and utility, would come down. If we see those ones coming down, most likely those ones will maintain where it is. And that's when we will continue, where we will see a continuation of lower inflation. But we're not seeing this at the moment. So the play continues to be bullish on US dollar. Okay. Hope it makes sense. All right. And DTSAs and New Zealand dollar outlook. Okay. Yeah, so I think the New Zealand dollar will continue to be bearish as well. We have the JPY that I want to later. The next topic would be Japan. It's very important. But most likely NZD JPY would be a good short, as well as NZD USD. Okay. All right. So third topic and last topic is the Bank of Japan, the potential policy shift. I was looking at some of my notes today, and I was like, interesting. So we do have a potential, 95% of the market is expecting 25 basis points hike from Bank of Japan next week. Some people don't understand why this is so important and why the market is felt so much in terms of like minutes. Okay. Some people think that the Bank of Japan is just as another Bank of Japan, but well, it's not like that. Okay, so Japan has maintained an ultra loose monetary policies for over a decade. It basically makes this potential rate hike very significant departure from the long-standing approach that they have held for more than a decade. Okay. The BOJ has kept interest rates near to zero or negative since 2016. Okay, so pretty much 10 years. And basically, they were aiming to maintain those NZRP, the negative zero interest rates policy, to stimulate the economic growth and to combat the deflation. This low rate environment created a very unique condition in the global market and making the yen a popular funding currency for carry trades. So basically borrowing in yen to invest in higher yield assets. So basically you were borrowing for cheaper and then investing for profit. Okay. Of course, it has a global market impact, and majority of them are if we have a rate hike from the Bank of Japan, it could make a reverse of those carry trades and leading to a very significant inflow of funds back into Japan and in strengthening the yen. Second is that the changes in the Japan MP, so the monetary policy, often have a very significant effect on not only in Japan, but as on a globally, global wise. So basically, Japan is a world third largest economy. It will definitely have a impact on that. And a shift into the Bank of Japan may encourage other central banks in the sort of Asia Pacific region to reevaluate those instances, and especially in the face of the inflationary pressure. So the third point is the domestic economic implications, right? We're coming from out of a decade to now just rate hike out of nowhere. What can happen in terms of domestic? Well, we have some signs of a robust wage growth as well as healthier economy support. They are supporting the potential for the tightening, and the raising rates could help curb inflation and stabilize the currency, which, as you guys know, has weakened significantly, especially in the recent years, in the last maybe 3-4 years. Okay, so that was quite a big one. But what could actually happen with the Japanese yen if the Bank of Japan do a 25 basis points hike? Sorry. Well, in the short term movement, we have the meeting on the 24th of next week, so I think it's on a Friday. The market may remain very cautious, and it will be limiting some pre-decision movements. Sorry, I was waiting for the CPI this night, so that's why I'm here like this. Anyways, so it basically in next week we may have some very slow USD JPY, not much happening because the market will be expecting something to happen from the Bank of Japan. So it will be building how can I say this word? But basically building a cautiousness about the decision. If then the rate hike actually happens, Japanese yen is likely to strengthen very, very quick and a lot. Okay. There's two reasons. Basically, the increased investor demand for yen denominated assets will be much higher. Second is the reversal of the carry trades. So a lot of people will be closing those longs as they know that it has probably come to an end. And as I say, USD/JPY could see as a downward correction, reflecting the yen appreciation. On the medium term aspect is we will continue to have a strong yen, and this will challenge the Japan export-driven economy, as higher currencies value makes Japanese goods more expensive abroad. So basically, if you want to buy things from Japan now, most likely will be more expensive. However, the tighter policy could attract foreign investments, so the FDIs, foreign direct investors, and it will provide some sort of support for Japan financial market. And as it always says, Guy, we have to work with two scenarios, yes or no. Okay. If no hike, market sentiment may weaken the yen further, especially if the Bank of Japan maintains dovish guidance. And if we hike, then we can expect a very strong move across global forex market, as well as the yen very, very strong, and some investors reevaluating the positions in the yen related trades. So just a little bit more of context. How long has the Japan maintained at the same rate? So there's decades of loose policy. So the Japan has a struggle with deflation and low growth since 1990s. Following the collapse of the asset bubble economy, and and then the Bank of Japan adopted a zero interest rates that they call the ZIRP, right? The zero interest rates policy into 1999, 9 years later. And later they've introduced the quantitative easing, the QE, to stimulate the economy. Then they had the negative interest rates on until 2016, and the Bank of Japan implemented the negative rates at negative 0.1% to try to further stimulate the growth and to combat the inflation. Well, the policy has been maintained for nearly 8 years now, and making it one of the longest periods of consistent ultra loose monetary policy among developed economies. Because remember, Japan is not an emerging market. The yield curve control, the ICC, is something that everyone talks about. And, it's one of the another cornerstones of Japan policy since 2016, that the Bank of Japan, they kept the 10-year government bond yield at the low levels to support the economic activity. And any move toward rate hikes or adjusting the yield curve control would be very significant on the Japan's economy, as well as Japan currency, the Japanese yen, and basically indicating that the Japan is ready to move away from the long-standing deflationary concerns. So, in my opinion, yes, we may have a hike, okay? And it's not only me that are expecting this. 95% of the market is expecting a hike from the Bank of Japan. Now, why the markets are paying attention now and not before, okay? Because we had happening before, but why is it so important now? What is the so important call it now? Well, first is the robust wage growth. So the wage growth in Japan has been historically very stagnated, if I can say that, but basically limiting the domestic consumption. But then we look at recent releases in the wage signal, very strong domestic economy, and this is a support case for the tightening. The second point is the pressures on the inflation. All right, we've seen some sort of inflationary pressures on Japan, and they are experiencing inflation above the 2% target for the first time in years, and prompting the Bank of Japan to consider its policies. And the third and last, in my opinion, is the global context. We have such other central banks starting new policies in major economies like the US, Europe, UK, Australia, New Zealand, Switzerland, sorry, everything. So Japan's move toward normalizing aligns very broadly with the global sort of market, in my opinion. And USD JPY movements over the last 10 years is most of the negative moves when we see downwards, like these ones we've seen on the screen. It's because of weather doing a forward guidance. It's because of maybe something happening on Japan. But then as just zoom out of it, put into a more bigger time frame, like daily. So, you know, those huge moves down, afterwards, they recover very quick, and then down, recovery very quick, down, recover, down, and recovery. Okay. So since 2021, we can see here there was huge move up, right? And I'm not saying that this will come all the way down, but maybe we can feel it something for next week. Going to the 1 hour. We can see somewhere around this area, okay? Somewhere around this area. Okay, so there is definitely opportunities as we broke down the level of 156 now, okay? So I hope this could help everyone to understand a little bit more about the Japan. So currently USD JPY and Euro dollar are correlated. Well, yes, they have a correlation of around, if I'm not wrong, like 70%. I'm not too sure, but I think it's around 70%. Okay. They have a correlation of around 70%. So yes, they are correlated, but it's different because when fundamental talks, it's the bigger point. So it's forget about correlation then, especially like an event like this one on Bank of Japan. Yes, traditionally they have negative correlation, correct? Because the US dollar on USD JPY is on the base and the US dollar on Euro dollar is on the quote. So basically it's the opposite move, supposed to be. But then now that things are a little bit changing, we may have a change of scenario, okay? But yes, you are correct. That's correct. It's like GBP USD and Euro dollar, let's say Euro dollar and New Zealand dollar against US dollar. Both of them have US dollar on the quote. So majority of the moves will be down, okay? Of course, it's not the same, but majority would be somewhere similar. Forex chat GPT. I like that. All right, guys, we come to an end. Let's just recap what we've seen. Where is my, there you go. Cool. So we've had a look at the US inflation, if it's cooling down or just pullback. And my opinion is that I think it's just a pullback. Majority of the all items, excluding energies, excluding food, is the energy that are, you know, driving the prices of inflation higher. The shelter prices continue to fall, but the majority of the energy, as I say, is continue to go high. So most likely we will continue to see some sticky inflation, maybe not higher than these, but at those levels. Okay, and this will prompt the Fed FMC to be somewhat a more cautious scenario, let's say. Okay. Second is the fiscal policies and the political dynamics on France. Most likely, this will weaken the euro. Okay, downgrading the pound, downgrading the GDP will probably weaken the euro. And third is the large potential policy shift that we've talked. 95% of the market is expecting a 25 base points hike in next Friday on the 24. So yeah, most likely this will push US dollar JPY down. Can you tell me the entries and exit of Euro dollar? Well, you could say let's go into the 4 hours. Look, there's a few ways you could enter it, right? I think it will probably come back again to the 102 area. You could enter now, maybe you have a drawdown, or you could wait for somewhere on here and then get a better pricing. Okay. But remember, the market can just continue to go down from here. So this is pretty much how you you're supposed to have your entry criteria. Will this be posted on the YouTube? I missed the better part of it. Yeah, for sure. It will be posted on YouTube. Tomorrow you can go to the YouTube channel and you will be able to watch it. Okay, in 24 hours. All right, guys, thank you so much for coming along. I hope everyone had a good time. I wish everyone a good weekend, and I see you back on Tuesday. See you guys. Bye-bye.